This is the European edition of Breaking Banks, the world's #1 fintech podcast and radio show. We bring you the European unicorns, startups, founders, regulators, and leaders innovating the rapidly evolving fintech scene today. A truly localized podcast with both English and local language content, with some of the world's most well-known hosts and influencers in the fintech sector globally. Join us every week as we explore what makes the European Union a phenomenal proving ground for many of the fastest growing fintech plays in the world today. Okay, let's roll.
Hi everybody, this is Breaking Banks Europe show, actually number unbelievable 174. And we are talking today about a topic which we titled actually Study Now, Pay Later, not Buy Now, Pay Later, it's Study Now, Pay Later. And I have very distinguished guests on the show today. And let me start with Marta, who is almost a frequent guest to our show. It's your second participation, I just learned. Welcome back, Marta. So I'm happy to have you. Tess Michaels is with us and Björn Wolf. And as always, I'm very happy once you guys would introduce yourself. And Marta, as you are a pro on Breaking Banks Europe now in the meantime, why don't you start? Tell us what you're doing, what you're up to, and actually why do I have you on the show? What makes sense for that, you know?
Thank you so much for inviting me the second time. So I guess the first was not that bad. I hope I'll do better today, just because this is very dear, obviously, to my heart and to my mission. And so I'm the co-founder of StudentFinance, and StudentFinance is a career mobility platform for reskilling and upskilling. And I think that's quite interesting because we will talk a lot about education financing. And I think the platforms that we have here today, I think we go well beyond financing. And I would love us to go deep on that part of obviously the conversation. And so Student Finance, we focus on higher education segments linked to the most in-demanded skills or kind of the biggest skills gap in the labor market. And I would say that we operate through 3 core pillars that I will go very shortly. The first one is the data layer. So a labor data infrastructure that allows us to really know what are these segments, right? What we ought to be obviously financing, but also what people ought to be studying. And I think that's particularly important in this stage of economy where things are changing absurdly fast. The second one is the financing piece. And there we started with income share agreements, and we will soon expand to fixed installments as well. And the third one is I would say, end-to-end marketplace between education providers, talent, and employers, which is obviously a fundamental piece when you approach, I think, education financing from an outcomes-based perspective, which we all do.
Marta, that sounds like the good old ecosystem idea you're following and platform, right?
It is, yes. But I think the core important thing here is that what we are trying to deliver to the users through an education financing, well, financing is the tool. We are here to deliver outcomes. And so everything needs to gravitate around those user outcomes. All
right, great. Tess, how about you?
Yeah,
Why do I have you on the show?
Yeah, no, absolutely. And first of all, I couldn't agree more. Marta, I think it's so critical. I think we're all in the space thinking about alignment and, how do we really drive the right incentives, especially around education, which is this inflection point in someone's life, right? Where, they may be a barista while they're in school part-time, but they're studying or training to be a nurse. And ultimately will have that, future ability to pay. My background is in finance, but I founded Stride Funding very much from a student-first perspective. I was a graduate student at Harvard. Sticker price was hefty, as you can imagine. And ultimately, I think many students go through, the back and forth of, is it worth it? Is the cost going to be worth, what the outcomes yield? And ultimately, we've evolved a lot as a company. We now have 3 products in market. Income share agreements were our first. Deferred tuition agreements are second. Non-cosigner loans are third. We play across degree and non-degree. So, more traditional university programs, as well as, upskilling and bootcamp programs, and healthcare and STEM are 2 of our largest segments within that. And similar to Marta, we also have recently brought employers into the mix to really help sponsor that education as well and connect that ecosystem. And so ultimately, it's all about how do we stay student-centric, regardless of the menu option or type of financing vehicle that we put in front of these students. So.
Cool. Thank you so much, Tess. Very exciting. Thanks for being on the show. And Björn, last but not least, but that's, being a gentleman, I'm happy you waited for your moment. Tell me, why are you on the show, Björn?
Thank you for having me. I'm Björn. I'm a co-founder and CEO of Lendorse. And with Lendorse, we're particularly focusing on students from developing and emerging countries who would like to further their education at top universities. In Europe right now is our operational focus. So the kind of social impact mission which we have is we're identifying talented students which want to take the next step. They have a more difficult risk profile than domestic students, just by the nature of where they're from. And we're really making sure that we're selecting the right students in the initial stage. We're funding them. We're helping them get a footing in a new environment. When they come, they just aside of the money, they need some support in the first steps. And of course, we're also very interested in them finding a good employment afterwards. And the vision we have is to create a financial and career ecosystem for high-skilled immigrants into Europe.
Okay, cool. Another very interesting component to the whole discussion. Before we kind of dig deeper, let us, for our audience, maybe describe the market we are operating in, because I could guess that maybe the one or the other is more like in my age. Studies are quite a while ago. It's more like for my kids an interesting discussion actually than for me. But being a parent, I think that's nevertheless very relevant and interesting. On the one side, what is the market we are in? In preparation for the call, I had a look to the U.S. numbers, as the U.S., I guess, is the biggest market for students financing and the most mature market for that very particular sector of financial services. And following the numbers, actually using ChatGPT for my preparation, I'm admitting this. Federal Reserve reported second quarter 2021 a total outstanding student loan debt in the US of approximately 1.5 trillion. That's a massive number, and it's even getting bigger once we compare that to the credit card outstanding loans, which is something like, for the same time, 868 billion. So, with simple math, something like the double of the credit card business. And we know that President Biden actually, and the Biden administration, is currently working on a ceiling for those student debt in order to make that a life-worthy living for postgraduate students paying back their loans. So how would you see the European market in comparison actually to the US market? Marta, maybe I start with you. What is your view on this?
So the traditional education financing in Europe is obviously very different from that US context. I actually think that we are still a growing side of the market, but a lot of education is going on, right? So actually, I think the emergence of the income share agreement platforms is being what is leading the education around education financing in Europe. And I think that's very important and interesting, because income share agreements bring this outcomes conversation. And so I think we are kicking off or opening up the European market from a very different lens than what you have in the US. And I think in Europe, it also tends to be a lot more focused on higher education versus the US, that you have that big component of obviously undergrads as well. And so I think the mix is very different and healthier in that growth.
Tess, you agree on this?
So we play entirely in the US. And so from the perspective of, working within a framework where, again, there is a lot of concentrated players in your traditional lending markets, I think the biggest pain points in the US have more so been around access to education for students who don't have a cosigner, which is really code for a wealthy parent, right, or family member. And ultimately in the US, despite the fact that many students may not have 7 years of credit history, most lending decisions are still based on FICO scores, which is a very traditional metric, which excludes a lot of borrowers who are high potential, but just don't have those doors open for them. And so ultimately, the reason we entered the income share space was because we were able to understand a borrower's future ability to pay and their expected earnings and the quality of the programs that they're enrolling in. And so we're able to enter a relatively concentrated market within the US, albeit a very large market, through a different vehicle like an income share agreement, which is, of course, very different than what you see in Europe.
Yeah, Tess, allow me one cynical question, maybe, and that's why I'm here. Actually, we all know that tuition fees at US universities forever have been extremely high. And when I started my business career, I had the opportunity to, at least for a summer course, visit Cornell University. So I really know what I'm speaking about, right? And that was in the late 80s, right? So could it be actually that tuition fees increased with, in parallel, the offer of student loans, because suddenly there was a higher liquidity in the market, so I can charge you more?
Yeah. So it's a very fair question. I would say a few pieces there. One, you're right. The rate at which tuition has risen in the US is, as you can imagine, pretty astronomical. Yeah. With that being said, we're one of the few players that plays across degree and non-degree programs, because I do think that, especially with outcomes-based funding products, there's this new wave toward really understanding what is the inherent ROI or value of these different programs per dollar that you're spending based on the quality of that education. And I think that puts a lot more onus or responsibility on institutions to really deliver on what they are promising toward. And ultimately, we do have a unique system with our federal student loan program, which, especially within the graduate market, is relatively uncapped. And so you can increase tuition accordingly, but ultimately that's not sustainable. And so I think we'll see a lot of changes in this space, especially over the next decade, around how programs are structured and what institutions are able to command, especially with all these entrants of certificate programs, bootcamp programs, apprenticeship programs that have been cropping up.
Yeah, it's all in line. I would say that we identify education to be a business, right? And once you shop for the solution at a business, it's also normal that, well, from once in a while you need finance for that funding for that in order. I do definitely understand that, in particular in Germany, where we follow up this kind of education justice philosophy, which means that all and everybody must have the same chances to access a university or any kind of education, resulted then in a state grant of BAföG or whatsoever in order to make those people study. I think that would be a different show to find out whether that really worked out or not, Björn. I'm not sure. What is your take on that?
Yeah, I think a couple of thoughts about this one. On the US versus EU, first of all, I think when we talk about value for money, there's a clear indication that in the EU there's a significantly higher ROI for education. So what we're looking at are our sweet spot are STEM degrees, kind of engineering technical degrees, where a student studies at TU Munich or WRTH Aachen or similar universities, and with something in the range of 10,000 euros, they can study for a year and have a solid kind of engineering STEM master's degree afterwards. Whereas in the US, you are very, very fast in the hundreds of thousands. And sure, maybe the expected earnings are slightly higher in the US, but just from an ROI perspective, Europe is very attractive. And then the second part with a kind of justice and fairness, it is nuanced. So when you talk about BAföG or other support programs, they're typically focused on domestic students. So if you're a domestic student, you have a lot of access to all kind of subsidized programs, subsidized loans from the government or subsidized grants or others. For non-domestic students, for international students, it is significantly trickier because they neither get the classical loan. If they come to a bank, they again ask for a SCHUFA score or a FICO score or whatever the local credit agency is, and wouldn't get a loan, and typically are just left behind. So when it comes to educational justice, there's a clarity that we do need additional labor force in Europe, and you can solve this by reskilling the existing labor force or by getting additional labor force into the continent. But there's clearly a lack of funding for them, and this is where Lendorse comes in. And we have specifically focused on Europe because we believe here's a higher ROI dollar for dollar, or euro for euro in this case.
I think even I did read an article again preparation for that show at the FT in the FT the other day, where one of I think it was the dean of LSE in London or King's claiming that they have a higher justice by the definition of people's access to universities because they are providing student loans, as much as I understood it, by the university or by the state. Repayable, actually, the BAföG, I think, as much as I know, is BAföG repayable or is it a grant?
It's complicated. Generally repayable, but if you repay it early, that's heavily subsidized.
Okay. And he's claiming that because there's a higher percentage of people leaving school then moving over to universities than in other countries in Europe. So obviously that seems to work. I would question it a bit, but anyhow, that's not for us. Now, after we spoke about what do you think? What is an ideal, and following your concepts, actually, I think you would have different definitions by that. But what is an ideal person you would recommend, actually, and to think about getting a financial support for his or her studies? Is there any kind of persona that you would see to be an ideal person? Tess, let me start with you.
Yeah, so ultimately, I don't think it's a one size fits all. The reason we have multiple products in our portfolio at Stride Funding is because ultimately these are menu options for students. And based on their background, their need, and their risk tolerance, I think different products work well. Ultimately, when you think about the early days of building outcomes-based products, the better your income prediction models are, the lower variability of the earnings of the program, the more affordable ultimately the product can be structured before you collect enough data and can start stretching those bands. I think that's probably why you've heard a number of folks on this call talk about fields like STEM, like engineering or healthcare, again, because of the predictability. Again, if we think about access, though, it's the ability to offer it across a whole variety of types of programs. And that, again, requires you to have installment products, income-based products, and others. And so, again, that would really be my view.
Isn't there the danger that you would create something like an oversupply on students, actually, or postgraduates? I remember once reading in the San Francisco Chronicle whatsoever that there was a Californian oversupply in lawyers, actually, because student finance partners did focus on exactly those studies and so on.
Yeah.
So in this year you had 10,000 lawyers. Your normal demand was 1,000, and you had 9,000 lawyers actually being maybe unemployed and not in the position to pay back, actually.
Yeah, I think first of all, we've each talked about different versions of how to bring employers into the mix so that there is more connectivity regarding placement and enrollment in these programs. But ultimately, there's still such a need for transparency. And when I say transparency, I mean, in the US, we have the college scorecard, and other data sources that do exist. They give you a lot of clarity on the quality of different programs and earnings expectations and the rest. But ultimately, it's not actually designed in a way that's very user-friendly, in a way that's, easily, understandable by the average consumer or student, right? And so most decisions around types of programs they should join, what type of profession someone should pursue, is influenced by your family, the people you grew up around, institutions that are near to you or that you know the name of and have familiarity with, rather than really understanding what is your maximum, willingness to spend, ability to borrow, ambitions as far as what you want to pursue, and the amount of time that you can invest in your education. And, we have a long way to go in the States, and I'm sure, in Europe as well, that I think we're all eager to start cracking at. So, yeah.
Okay. Marta.
Yeah, I definitely agree with Tess. I think in Europe, we are, I think, significantly behind in standardization of, how we evaluate that quality, on how schools are actually tracking the outcomes. So something that we saw when we started in the market is that there was a significant discrepancy between the data that school reported and the actual data that we verified, right? Obviously, for student finance context, we launched in 2020. We've gone through a pandemic. We've gone through now the current, obviously, economic cycle. So that massively affects outcomes, salary levels, et cetera, and placement rates and cycles, certainly. But it's very important that we create the dialogue and transparency on how we are actually monitoring and communicating to users this data, right? Because that should be a core part of how their decisions are made. And also going back to the point that you're making on kind of oversupply, I think it's crucial that we're monitoring these on an ongoing basis, and that there is a layer of distance between the platforms and the education partners / segments, in the sense that we, Student Finance, we always communicate that we're kind of sector agnostic. We exist to empower access to education, in our case, reskilling and upskilling, to where society and companies need it the most. What we need is to monitor what these sectors are. And for instance, now we are focusing a lot in mapping the green skills market, so supporting the transition to the net zero economy, which is something that is massively growing in demand. But when we were fundraising, we had a lot of investors who would ask us like, oh, but why don't you go vertical? We don't want to go vertical exactly because of that. We don't want to be so involved into obviously the segment or the vertical that we're addressing that we cannot make that data-based decision on when, okay, now data science is enough. We need to be training people into the other segments. So obviously what we ought to be training people to and financing people into needs to be dictated by data itself and what the labor market and society is needing the most.
Björn, I think your approach is different because you're focusing on students coming from emerging markets, as much as I understood it, coming to Europe and studying in Europe. And I could guess then maybe going back to their home country and taking responsible higher level leadership and decision-making positions there. But nevertheless, what is your take on that? So your target group, I would say, is pretty specific in comparison to Marta and Tess, and you made a decision on this. So why did you do so? Yeah.
Sure. I mean, basically, we saw there's a gigantic gap in the market, that there's essentially an underservice for people from developing in emerging markets. They want to study. In many cases, they have the admission letters from the university. They could study. They're just lacking the money. And it's pretty clear cut. If you don't prove that you have enough money to get a visa, then you will not get a visa, and basically you will not enter the country. So there's a pretty strict one. So we decided to tackle this problem. Both because there's a strong social impact angle. We want to make sure that everybody has a chance to get the education they want, but also, of course, financing people. There's money to be made. It's going both in parallel, and we're focusing to begin with also on the STEM subjects and a few selected business schools, precisely for the point which we mentioned earlier. The predictability in the beginning is just easier, and with a oversupply. Just one last sentence to this one. If you have an outcome-based payment, like an income share agreement, it's actually actively against the oversupply, because if somebody is studying something which is not needed by the market, they will have a tougher time getting either no offer or worse offers. And if someone is studying something which at least the financing partner deems to be needed by the market, it kind of incentivizes them to go into the areas which are underserved and disincentivizes from the others. So I would say quite opposite to what you said. Outcome-based financing is kind of actively combating oversupply in areas.
Which then actually is creating also the question by the selection. Actually, the question is, why would we leave it to business decision makers what to study and what not, and whether this is social or good for a society, and which banks maybe to support you on all this business and much more we're gonna speak about in the second half of this show. So stay tuned and listen to our funding commercial break in the meantime.
At timepledge.org, we are building the largest free coaching and advisory platform for entrepreneurs by providing mentorship opportunities based on pledged time. Our network of seasoned industry experts acting as coaches is working for free, pledging their valued time to the next generation of entrepreneurs who will change everything. Our portfolio of sessions goes over every skill an entrepreneur needs to successfully launch launch his or her startup. From how to pitch and behave with investors to how to best market your idea online, or even how to best manage your team, we have the perfect sessions with the perfect mentors. Want to learn how to become the best entrepreneur you can be, or mentor the next generation of entrepreneurs in Africa and Asia? Please visit timepledge.org and let's get you started.
Here we are again. This is Study Now, Pay Later. That's the Breaking Banks podcast and show number 174. We still need to do this show. You know, we need the money, so nobody's lending us money. And we didn't study, otherwise we would have a very good profession. We just discussed actually about customer selection. What are the personas we are supporting? As I like the phrase, actually, Marta, I think you said it, ISA platforms, which is something more technically, isn't it? So it's an income share agreement. So you regard yourself to be an income share agreement platform. That's the technical term?
So we've started with the income share agreement product, which is built, well, in our perspective, or most suitable for the reskilling use case. So people going for these big life transformations. And the benefit of the income share agreement, so, we actually, I would say the biggest difference is for income share agreements, we underwrite based on future income versus your current income. And that allows us to obviously support a lot of people who are underemployed or unemployed. Actually, no, through the history of student finance platform, we had a lot of times that roughly 50% of our applicants were from this segment, right? And that allows them to actually go through these big life transformations with the financing support. And this segment would certainly be rejected in any traditional financing, obviously, product. Also, they're going through a big life transformation that is daunting, right? This segment does need, obviously, the downside protection of only paying once they secure a job and can afford it. And they need a lot of support for job placement. So, we believe that is absolutely the right segment for reskilling. But when you go for upskilling, and upskilling is a huge market, nowadays we are obviously in the world, I don't think anybody disputes of lifelong learning. Each of us needs to do training every 2-3 years. And that applies to everyone. It applies from people who graduated 2 years ago or someone who is in the labor market for 40 years, right? And so we are also developing products that are suitable for people throughout this journey. But of course, when you are employed or when you have a stable income, you want to defer payments, you want a flexible payment structure, but you don't need as much that downside protection and obviously that cycle. And so we are developing products that are suitable for the different segments across obviously the reskilling and upskilling journey.
Okay, so what is given the fact that I guess none of the three of you actually is holding? Is there any financial services license required for the business you're doing? Tess, sorry, Tess, yeah.
I think there's a few components here. So we've raised about $150 million to fund the assets themselves via banks and credit funds into special purpose vehicles. So we separately raise venture dollars to fund our platform and people, and then raise credit facilities to fund the students themselves. And so that's one piece when we think about it from a financial perspective. And then also within the US, the space itself historically was very much in a gray area from a regulatory perspective of, do you need licenses to operate a financial product like this? The days of that are gone. In the US, it is much more black and white, which we are so grateful for. We have always treated our products like traditional loans when you think about it from consents, disclosures, and the rest. But now we also work with a chartered bank partner to have the equivalent of state licenses in every state. And so that ultimately gives us a lot of regulatory rigor when we're actually offering and originating these assets.
Yeah, makes sense, I think. Björn, how's that with your solution?
So in Europe, the situation is a little bit different. So in Germany, where we're kind of most at home, there's KVG, which is kind of the big banking law, which everybody is worried about. And the question is whether an income share agreement is a loan or is not a loan. And the BaFin is relatively explicit in this regard, and they're saying a loan is something that has to be unconditionally paid back. If there's an unconditional duty to pay it back, it is considered a loan, and it is treated by all the kind of lending regulation. If there's no unconditional duty to repay, which, for example, if the student doesn't find a job or gets sick or something happens, this is when it really differs in the European perspective from lending, and this is what makes a difference. So the important thing is to make sure that it is really outcome based and there's no duty to repay it. Otherwise, it would fall under lending regulation, and ensuring this brings it out of the lending regulation in Europe, unlike US from what I understand. Of course, notwithstanding from this, whenever you're collecting the money, and it depends a little bit on your structuring, if you do it through a fund structure or SPV structure, of course, there's tons of regulation on this side, but I think the difference from the US and the European perspective is really in this kind of unconditional repayability, which makes it under a European directive, not a loan.
Which means, explain me that, Björn. This means actually I'm falling sick at the end of my studies or whatsoever. I have a loan. You did lend me some money or whatever you want to call it then. You have an ISA with me, let me call it like this. And for that ISA purpose, you gave me money. And now actually just before starting to pay back, actually, I fall sick. And then I do not need to pay back? Or
that's precisely right. So in a traditional loan, you have a principal and you have an interest rate, and you have to pay back both the principal and interest rate, no matter what. And if you don't pay it back, there will be kind of foreclosure, and they take your stuff and your car. For us, we're underwriting a student, and we say, for example, we're going to get 8.3% of the income for 4 qualifying years, as an example. And then if the income during these 4 qualifying years is higher, we get 8%, 8.4% of this higher number. If it's lower, we get less. And if it's below a certain threshold, the duty to repay isn't happening during these 4 years. It moves a little bit back in time. And if there's a total contract duration which is extended, there's no obligation to repay at all.
I would just quickly add, I think it's important to note that most players in the space make sure there's a number of standard deviations from what that minimum income threshold is and what the expected earnings is. And ultimately, I know at least at Stride Funding, and I'm sure at both of your companies as well, we put a lot of thought around maximum percentages of income that we will charge. So there's no moral hazard issues around folks changing their behavior so that they are not earning above that threshold. Ultimately, it's in their best interest to make 95% more money versus not pay 5% of that income, right? And so it has to be structured in a way that is student-centric, but also that recognizes this is a real obligation that across a diversified number of students should make this sustainable so that there is more capital in the space to keep these types of products in flow.
It's actually both to some degree. So what we observe is both the percentage is tricky. If you're taking too much of the percentage, it leads to some unwanted behaviors, but also the duration. If we're funding the student, we don't want to extend it beyond a certain amount of time, which is nice in the European context because education is relatively cheap. I would imagine this is more of a challenge in the US. If you have a very expensive educational program, you need to make the money back. Either you have them pay back forever or you charge relatively high rates. But that's just, I think, one of the differences between the EU and the American context.
So Björn, what is your average ticket size and what is your average duration then? If you may share that, or if that's confidential, let me know.
Sure. No, it's not confidential. So ticket size, we typically go for like I mentioned, state sponsored engineering schools. So something like TU Munich, RWTH Aachen, similar type of universities, or some business schools. They have different prices, but on the engineering, it's around 10K typically our ticket size, which we give to the students. And then in terms of the percentage and duration, of course, it depends on the student and on the amount and a bunch of other factors. We try not to let it go beyond 12% of the gross income, and typical contract duration something between 3 and 6 years. It really depends, but it's really in our case a relatively short amount of time and a relatively low percentage of the income, which is only possible because the total ticket size is relatively modest.
Okay, say it again. So duration is 3 to 5 years.
Yeah, 3 to 6 years, something like this. Yes.
3 to 6 years. Marta, on your end, ticket size, duration, gross income, 12%, by the way, 12% income, by the way, on gross, 12% on the gross income could easily be whatever, like 20% on the net.
It's a max.
It goes, it goes, I think the average in European tax brackets, it goes, I think, around 16-ish, but yes, which again is still affordable, and I think affordability needs to be obviously a central conversation around this. But for us, it's similar to Bjorn. So our ticket size. So we operate in the UK as well, which have slightly higher tuition fee levels than our European jurisdictions. But now it's around the 10,000 euros ticket size, and typical duration is 3 to 4 years.
Okay, very similar. So
I would just like to make a note on the regulatory side, if I may, just because
please go ahead. Sure.
We work across European. So we are authorized by the FCA, so we do have a regulatory license, and I think just like Tess, how our approach to the market is, we are compliance first. We actually designed a product to be generating value for users, and we are here to obviously deliver that value and give them all the user protections that they deserve. So I guess the question when you go about market expansion is not about those kind of compliance and best practices, is about what are the license barriers for you to launch in a new geo for student finance, right? And I would just like to highlight that even when you go for traditional consumer lending, that is not harmonized across the European Union. It massively differs. So in Spain, you don't need a license. In Germany, you need a license. And I think for income share agreements, we have been speaking with a lot of regulators across Europe, and this is far from being harmonized, that income share agreements are not treated. The BaFin is one of the examples, and there are other European jurisdictions where they put income share agreements under an exemption, but there are other regulators, like Portugal, where I live, that they see income share agreements as much a traditional loan, and they would expect you to obviously follow the authorization and licensing processes as any consumer finance process. So we need to approach these geo by geo, and our approach to student finance is, again, we engage with regulators, we explain the product, we explain how we underwrite, what are we trying to achieve by designing the product in this way. And then if a license is required, then obviously we will follow suit. I think at our stage, because we are already licensed in the UK, or authorized in the UK, for us, we have a regulatory playbook, and it's quite easy to turn this around, because although it is not harmonized, what you need to comply with, it's very similar, right? It's designed in a way to be very similar across geos. So I just wanted to give that note on regulation.
Well, that's extremely helpful, Marta. Thank you so much again. And for the ones who do not know, I've been CEO of a bank for more than 20 years. So I'm in particular interested, once I hear that once people would not pay back, out of my perspective, a loan, right, that we just write it off. And that's it.
But you see, regardless of the regulatory context of the product itself, that is how income share agreements work. So you see, in the UK, we are authorized. We require a license that is very similar from a traditional consumer lending license, but still, that is the mechanics of the product. If a user does not get a job earning above the minimum income threshold through the duration of the contract, they will not pay 1 cent, and the contract will terminate in good standing. They are not defaulted. It just means that we as a platform need to write it off. But also, you see what that creates is that it is our responsibility to support the user in that journey. But also, I think it brings another thing that is, I think, absolutely critical for our platforms, which is income verification. We need to make sure that we're getting access to real employment data of the users, and that part is something that we at Student Finance have been focusing a lot. Again, for us, it needs to be done geo by geo with integrations a lot of times to either payroll providers or to social security and tax authorities themselves. But this is crucial because users, or some users, will try to play the system, which means, again, or they go, or for instance, users that go through a freelancing route, right? They create an entity, and then it's very hard for you to verify which income they are reporting. But this is crucial for income share agreements, that we have a direct access to the source of truth when it comes to income validation. And I'm sure Tess and Bjorn, I'm sure you agree on this part. And it's something that for us, it will be extremely helpful, that would be standardized in a cross-European basis. Now, obviously, it's very national.
Marta, I think we will, none of us, even you that you're much younger than me, we will not experience any harmonization on that topic in Europe. Forget it. Just simply forget it, right? And I gave up on that totally. Tess, just allow me to come back to my kind of number question: ticket size, duration, and percentage of gross income. How does that play out on your end?
Yeah, so again, we play across degree and non-degree programs. Our non-degree programs, the average ticket size is usually $10,000 to $15,000.
Okay.
Duration is, call it, 2 to 4 years. So very similar, frankly, than both of you. And the other piece, which I think gets lost oftentimes, is people see the total tuition cost in the States, but the bulk of that tuition, we always recommend students take subsidized federal loans first, tap out on that, and then students look at private loans. And so ultimately, the actual gap that most students need, even for degree programs, is only $15,000 to $20,000. And so it actually ends up being fairly similar as both of you, where the durations of those products are 4 or 5 years, right? And so in a lot of ways, what I'm at least getting out of this talk is, as different as we may have started the conversation across the US and Europe, there's actually so many similarities. And just like Marta, you talked about the geo differences, we have differences in states in the US on how California thinks about, different loan products versus, Colorado, et cetera. And so ultimately, you always look for ways to standardize. That's why we work with a charter bank that did a lot of the heavy lifting, understanding what requirements were across each and every state. And it's, why, exactly like you said, you need great middleware to do income verification, employment verification, and to know exactly where your borrower is so you can support them best and also deliver on a really good product. So
excellent. Thanks so much. So that means actually that brings me to one question. What is the expectation of your investors actually? So to speak about motivation and incentives, and synchronization of incentives. What is even I might be an LP providing US dollars that you then organize to be distributed with the students. I might be maybe a bank that is providing a part of its loan book to be distributed via your platforms. What is the expectation of those partners? I'm sure they are not doing it just for the positive impact on society, are they? Tess, maybe you start again.
Yeah, so it's interesting. We've actually worked with a whole spectrum of investors at this point. We started with large impact investors, multi-billion-dollar nonprofits in the States that truly did want to focus on that double bottom line. They wanted a sustainable return, but ultimately were really focused on us being able to increase access for students across the States. And cost of capital was very low. I mean, senior debt at low single-digit yields, which allowed us to scale and offer flexibility of a product, but also affordability. We then had enough data to back that we had, a viable product to then bring bank capital in. We were actually the first player in the US doing income share products to bring a national bank in. And then our latest fund is very traditional credit investors as senior debt and mezz. And ultimately, what it's shown us is there's appetite across the board. The question is, based on their return expectations, some may be more interested in non-degree, shorter term programs versus others may have more appetite across longer duration, more traditional programs.
Okay.
So
would you see that? And Björn, I'm looking to you then, and I add another question on top of that, what we just learned from Tess actually. Would you see that then under stress in a changing interest rate environment? Now that we have increasing interest rates on the market, maybe money would prefer to stay with more secure investments, providing whatever, like a 3% yield and so on a 5 to 10 year bond or whatsoever. And maybe money is not that easy to get anymore for your product and services.
Sure. First of all, in terms of the sources of money and also the motivations of money, I want to underline what Tess said, particularly for us. Enabling people from developing and emerging countries, also have a specific focus on women, because oftentimes women, like if a family only has enough money to send one child abroad, it unfortunately in many regions tends to be the boy, no matter who has the better grades in the family. So the social impact part is really strong, and this of course does play a role. If someone says, this is not just a for-profit investment, it's not just selling whatever tobacco or firearms or something which makes a maximum return, but there's a social impact angle here, which in our case is particularly strong. So this does play a role. On the broader picture, I mean, logically, anyone who's dispersing money and needs to take in money on the other side, of course, if interest rate goes up, if the entire tide goes up, you have two options. You can pass it on to the student, and that's possible, but that's ultimately going to be an issue with affordability, like Tess mentioned, or you can kind of hit your own margin. So overall, yes, as money dispersers, interest rates do play a role, but since there's a specific social impact angle, it's not just the pure capital markets, but it's a combination of social impact and the financials.
Okay, Marta, you can confirm that?
Yes, we could definitely confirm. What we see happening as well is that there are a lot of benefits these days for traditional finance players, meaning asset managers, credit funds, banks, etc., on the ESG side, right? So they even have funding benefits to be playing in the ESG space and doing obviously transactions with a positive social impact. So I think that they are also wanting to enter this space, and we find a lot of traditional players attractive to our niche, exactly because of the impact side, although obviously they are validating track record that the operation works, that the economics work, and that we will be here obviously in the long run, that the false rates work, etc. And so I think this is an extra that allows us to access the market, and I think it's a massively leverage versus non-impact or non-ESG platforms accessing the market at the moment. Right, because certainly now that cost is being passed on to the platform. At Student Finance, we also closed a large facility with an asset manager last year. So we actually we have a fixed cost of funding for the next couple of years, and so that will obviously helping us to navigate this cycle with stability. But we are in contact with a lot of players, and we hear that certainly these costs are being passed on to end consumers, because otherwise it's just unsustainable for platforms to be operating at negative net income margins.
Yeah, I understand. Actually, you could claim that you're following the UN sustainability goals, and I think it's goal number 10, fighting inequality, actually, that you are acting on, right?
So we at Student Finance, we believe we touch 3. So
at least.
There is quality education. So the number 4, which we believe we are tackling. The 8, which is decent work and economic growth, which again, when you are doing success-based financing, this is the goal. And so very strong on that one as well. And the last, the 10th, the reduced inequalities, which
and fighting poverty, isn't that another one? Fighting poverty, absolutely.
Eventually, yes.
Yeah. So wrapping it up and coming to the end of the show, now let us actually speak maybe to the students, and let me allow you to actually maybe give a little bit of advertising for your platforms and solutions, because as much as I understand now, out of, again, the banker in me speaking, out of risk management necessity, we of course need to take care of the loan taking party. And as you explained me, we need to take care that this person is getting the best possible job with the best possible payment, so that the likelihood of repay, actually, no matter whether we treat it as a loan or not, anyhow, we need the money back. Actually, the likelihood is increasing. So what are the services and solutions? And following this ecosystem platform idea, actually, and I'm going to ask each of you, what are the services and solutions you provide me as a student on top of just giving me the money, Björn? What on top do you provide me to kind of give me support for my young life in this situation?
Sure. So the way we look at it, it's almost a bit like a VC fund. We have to do 2 things right. We have to make the selection in the beginning. This is very important. If you select someone who ultimately was not the right person to select, it's very hard to ameliorate it later. And then secondly, during the student's lifetime, it's important that the student succeeds as best as possible. For us, concretely, this means when they come, we want to provide them with a kind of good first foothold in their new country. Meaning, if you come, you need a current account, you need a health insurance, you need a liability insurance, whatever, a couple of additional steps to get sorted. Then throughout the studying, we have semi-annual progress reports where we're staying in touch with a student and get a kind of rich qualitative view of what the student's current situation is. If there's any indication of a problem, we have a team of volunteer mentors who can step in and support the student. And then the very important phase is towards the end of the studies, when the student is wrapping it up and is about to enter the job market. The areas we look and support are everything that's career related. So first of all, what is a career? How do they apply? Some people, particularly in the STEM field, are technically brilliant but aren't the best at marketing themselves. So when it comes to how do I even apply, do I write one application and make it really good, or do I write 10 or maybe 50? Like this type of topics. We have tools for this. And then, of course, optimizing a CV, making sure this is a CV that is kind of good on the market, helping them with negotiating the salary. Kind of course, each percent they get more is more money for us, and cover letter and similar topics. We haven't closed a lot of employer partnerships yet, but this is on our further roadmap to get more and more employer partnerships. Because if we say, here's a pool of 50 high qualified STEM students, and they would like to enter the workforce, particularly for hidden champions somewhere in the deeper country, it is very tough to get access to these types of talents. And this is essentially what we do. So select first, and afterwards help them orient, accompany during the study, and then support them in the job finding.